The dollar sits at 98.8 and silver drops 7% in 1 week. At the same time, gold holds above $4,700. Those three numbers do not usually align without stress building underneath. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, yields just pushed to 4.31% and metals are diverging hard. Let's get straight into it. Lead story today: U.S. Treasury market and dollar index positioning. The 10-year Treasury yield trades at 4.31%. The U.S. dollar index prints near 98.8 after a weekly gain. Gold holds at $4,626.58 within a $4,684 to $4,653 range, effective this week into the April 29th Federal Reserve meeting. This follows a month of declining dollar strength before reversal. The unusual detail is gold not breaking under pressure. Silver drops nearly 7% while gold remains stable. The timing is what deserves scrutiny, not the move itself. The timing. Think about what that sequence actually means. Rising yields and a stronger dollar usually pressure gold, yet gold holds while silver collapses. That divergence signals different underlying demand structures. What does it mean when gold absorbs macro pressure while silver cannot? The ones paying attention already know what to watch next. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Before I show you the full data picture, consider this. Gold is up over 41% year over year. That is happening during rising yields. That is not normal behavior historically. The data is already telling you something. Let's build it out. Now let's build the full picture because Treasury yields and gold pricing do not exist in isolation. U.S. Treasury data shows 10-year yields at 4.31%. ICE dollar index data confirms 98.8 levels this week. CME Group gold futures show stability above $4,700. Shanghai Futures Exchange silver pricing shows 85.35 per ounce. That creates a $10.05 premium over COMEX pricing at 74.65. Compare that to historical premiums under 2% across most years. JP Morgan and Goldman Sachs projections place gold between $4,000 and $6,300 for 2026. Central bank purchase data from IMF reserves reports show continued accumulation. China, Malaysia, South Korea, and Uzbekistan report steady buying. The rate of accumulation is not slowing, it is compounding. The data is doing the talking. The ones who have been dismissed for tracking central bank flows are not saying much right now. And here is what makes that picture even harder to ignore. Gold to silver ratio sits near 63:1 currently. That is above the long-term average near 60:1. Silver trades at 74.65, while gold holds above $4,700. At the same time, silver demand depends heavily on industrial cycles. That is not a contradiction. That is the setup. And before anyone takes that as a green light, timing remains uncertain. Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. 21 million barrels per day through the Strait of Hormuz. Now, geopolitics, because this is no longer a backdrop. It is the primary variable. Energy flows remain constrained through Middle East tensions. Oil prices remain elevated above recent averages. Inflation expectations remain firm due to supply constraints. The cost of energy directly feeds into global pricing structures. Markets are still pricing stable geopolitical conditions. Look at oil flows and tell me that assumption holds. When markets start pricing disruption risk, gold reprices higher. Silver reacts differently due to industrial sensitivity. That is the historical pattern. Every time energy shocks drive inflation, gold outperforms silver. It has not been different yet. Gold Western spot at $4,726.58. Shanghai pricing reflects strong demand near global benchmarks. Silver trades at 74.65 with Shanghai at 85.35. That is a $10.05 premium. Short-term picture shows gold resilience and silver weakness. Key level for gold sits at 4,684 support. Resistance sits near $4,120 to $4,900. If the dollar reverses from 99, gold moves higher. If yields push above 4.35%, gold tests lower support. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold or silver does tomorrow. Nobody can. If you think you know, good for you. Current conditions show macro pressure and structural demand colliding. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. The US dollar index at 98.8 pressures gold pricing directly. The 10-year yield at 4.31% raises opportunity cost for holding gold. Silver demand weakens under tighter monetary expectations. The bull case is equally real. Gold holds $4,626 despite macro headwinds. Central banks continue accumulation across multiple countries. Shanghai silver premium at 10.05 signals physical tightness. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. Gold is holding because structural demand offsets macro pressure. Silver is falling because macro pressure dominates its demand profile. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group, ICE, IMF reserves data, logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook, do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.